So let's talk about helping your kids buy a house. A lot of parents are tempted because they want the best for their kids, or maybe things are just a little bit off in their worlds as far as financing or jobs, or maybe the credit with the weight of student loans. Well, if you're a parent and you're thinking about doing that, I've got 3 things that I want you to really be careful, at least be informed about before you take the plunge on that. This is Ron Wojciechowski at Wise Home Team Realty with 3 things that parents should watch out for if they're going to co-sign. So, number 1, you've been asked to co-sign on a loan, which sometimes means, hey, could you just buy us a house? When in fact, that's probably what you're doing. If you are co-signing, it's just like you buying the house. Now, if it's your son or your daughter, or maybe your son or daughter is married and there's a spouse involved, it's wonderful. You want to take care of the grandkids. You want to make everything perfect. Very cool. But when you sign up and the mortgage payment is $2,000 a month, if they don't make it, guess whose credit gets ding, ding, ding? That would be yours. Let's suppose that marital bliss turns into marital unbliss. Guess who's still on the hook for the $2,000 mortgage payment? If you guessed, you, the parent, you are so correct. And let's suppose, in the worst case, that marital unbliss leads to separation or divorce or whatever that looks like. Someone's moving out of the house, someone's responsible to pay for the mortgage, and you might be in a really compromised position of having someone who is soon to not be your family member in the house that you might have to either allow to stay there, create a lease with, or possibly evict. Now, does it go this way? Not very often. But should you at least be aware of the risk you're taking? It's not just a financial risk. It's absolutely the risk of one day having to evict someone that's part of your family. Kind of crazy. So the first thing is, make sure your eyes are open. I hope that number 1 has been covered with that last little rant there. Be careful. Now, the second thing that you want to look at is you're likely to have to be able to qualify based on your current income. So if you're retired, which a lot of people have retired, and maybe you're making $100,000, and in retirement you're making, less, half of that. If you've got an existing mortgage, maybe a car or a boat loan, you may not have enough room to actually qualify and fit that whole mortgage under because you're not splitting it. You have to apply as if you're taking on the whole mortgage all by yourself, even though your family's involved when you co-sign. You're going to have to qualify. There's a reason that they're asking you to co-sign. It's because they can't do it on their own. And it's not a bad thing. They're just not able to do it at this time. That's the nice way to say it. It further compromises you. Let's suppose that you want to do something. You've got your own home. You've got your car, your boat. You've co-signed for their home. And now you found the perfect beach house. And now there's no room for you to actually get what you want. So make sure, sit with your financial advisor and draft up a plan that really makes sense, that you've got some room left in your budget for something like a beach house. Or on the other side of it, maybe there's a medical thing or a hospitalization, something unforeseen where you may need to tap into some equity lines. Just because you've got equity in a home doesn't mean that you can get an equity line. They always say the time to apply for a loan is when you don't need it. When you need it, sometimes it doesn't work out. So let's make sure that we've left enough room in the budget to fulfill this. Now, the third tip, and the third thing I want to talk to you about is understand the titling of the property. What does that mean? Well, it means if your name's on the mortgage, you should be on the title. You're going to have to be. But so is your son or daughter and their spouse and whoever, or uncle or sister or brother, whoever else is on there. You're all financially responsible together. So as time passes, those responsibilities may or may not be upheld by other family members down the road. So just understand that when it comes time to sell the property, everybody's got to agree to sell it. So if 3 out of 4 people want to sell it and one doesn't sign, guess what? You don't sell the property. Now, it's not likely to happen, but can, of course. We want to talk about these 3 things as anybody gets in the position of being asked to co-sign and actually accepting that challenge. It's a wonderful thing. We do a lot of it, and I embrace it. But make sure that you're doing it the right way. A lot of times, the parents will step in, and what they'll do is they'll actually get the mortgage and buy the house in their name, and they'll figure out something, whether it's rent or the kids just pay the mortgage, and one day the kids will buy it from the parents. Happens all the time. There'll be a few closing costs down the road, but it might be the most safe and secure way for the parents to have the most control, since they're taking the most risk, to making that property a successful purchase and keep the family all in line together to be able to enjoy it. And let's face it, the reason you're doing it is because we're positive it's going to work out great and the family's going to grow and everybody's going to be happy. And that's what we want. And these 3 tips are going to help you keep it that way. This is Ron Wojciechowski talking to you about co-signing for a family member. If you like this, click or comment below, or just check us out on Ron Sells the Beach and drop us a line. We look forward to helping you out.